turn now to the Muni market, because here with us on set with more on what investors should keep in mind is Alex Petrone. She is Director of Fixed Income at Rockefeller Asset Management. Alex, we were talking with Ira about supply and the onslaught of supply, at least for U.S. Treasuries. What does the supply picture look like for munis in the short term versus the long term?
Yeah, absolutely. Critically important question, Scarlett, because when we look at supply dynamics thus far, it really is kind of a key factor that we look to as portfolio managers in terms of when we think munis might outperform or underperform treasuries. What we saw over the course of the last several years is municipal supply has been quite light. What we're hoping for in 2024 is that municipalities will step in and issue more debt. We anticipate that you start to see a move towards 400 to 450 billion over the course of this year. Now, what we're looking for typically is when that supply comes to market. This week has been one of those weeks where supply starts to increase materially. Those are the moments where we look to some of the seasonality of the municipal market, and those are opportunities for us as investors to say, are we cheapening a bit versus the broader market? Municipalities have been quite prudent up to this point and aren't issuing as much as we've seen in the past, and we think it's at the point in time where they need to step back in, and we'll see that.
So I'm wondering how you factor in headlines that do come out on municipalities. For instance, California Governor Gavin Newsom is proposing spending cuts next fiscal year to reduce the deficit to just under $38 billion. The previous projection was $68 billion, so that's quite a big change. What does that mean? How do you factor that in? How do you think about what that means for supply when it comes to California debt?
Absolutely. It's not just supply, but it's also looking at the technical factors. So whether spreads widen on some of these headlines, yes, budgetary shortfalls should be expected as we move forward. This has been a period in the last several years where when we take a step back and we look at credit fundamentals in the municipal market, we look at a couple of key things. Number one, upgrade to downgrade ratios more broadly. What we've seen over the last several years is that upgrades have far surpassed downgrades across the municipal market. 80% ratio when you look at tax-backed sectors, so think state and local government debt, 70% ratio when we looked at revenue-backed bonds. The next thing we look to, of course, are these periods where we enter into a bit of a slowdown. Now, the Fed is telling us we believe that the economy is slowing, right? They're saying that we can back off a little bit from here, so it shouldn't be a surprise that tax receipts are declining and some of these budgetary shortfalls exist. What we're looking towards is what are the responses to that? You mentioned Gavin Newsom. I think we also have all seen many of the notes that they will tap into reserve funds as needed, potentially raise taxes. The wealth tax, of course, is being talked about right now. So there's a lot of fiscal flexibility here, and that's really important. Now, what we're looking towards is not just the issuance that then is required, although municipal issuance is usually for the use of some type of project finance, but I think importantly, if some of this noise around headline risk turns into negative watches by credit agencies or just discomfort from the general public and spreads widen in storied credits, we actually view that as an opportunity to potentially add.
Well, let's talk about that, because we were supposed to get that spread widening last year in 2023, and we didn't really get it. I mean, I know they widened a bit, but that was like minuscule here. What's the widening that you look to where it starts to become attractive?
Well, make no mistake, 2023 was a year of a lot of volatility within the municipal market. That volatility was really driven by two key factors. Factor number one, the tremendous amount of volatility that we saw in U.S. rates. And munis will always move along with. In periods in which we see supply elevated in the municipal space, and it's not just new issue supply, but it's also looking at secondary selling pressures. You had a period in 2022, tremendous outflows, 2023, a little bit better in terms of fund flows, and so you did have periods in which spreads might widen in certain sectors, in certain credits, in certain structures. As those things were happening for us, we love that in high quality credits because it creates opportunities to invest and add. Now, spreads have tightened. Ratios have become much richer over the last couple of weeks. That's driven by a little bit more stability that we got out of the rates market coming out of November and December.
But the economic picture is still there, and if you broaden it out from just munis and you look at the broader credit landscape, fixed income landscape, there's been a lot of chatter about whether we're headed towards some sort of credit down cycle, if you will, here. And we had some downgrades on some companies today, primarily because of that over at BMO. I'm wondering if that is a concern for you right now.
It's always, credit trajectory matters. So where we are at in the macroeconomic cycle is going going to impact companies. It's going to impact municipalities. That other key factor for the municipal market is looking not just at downgrades, but defaults.
Yeah.
Defaults are a really key indicator. I think investors historically have been terrified of municipal credit relative to corporates. When you look at default statistics on both an absolute and relative basis, they are quite low, both in the near term and over the long term. Defaults in the muni space, 1% last year. Does that tick up a little bit over the course of the next year? Yes, I think so. That seems realistic. When you look over a longer term time horizon, 30 plus years, in the investment grade universe, that default rate has been about 0.4%.
All right, Alex, illuminating conversation. Alex Petrone there, who directs the fixed income business over at Rockefeller Asset Management.